Today, we're diving into Snowflake Incorporated, one of the most talked about cloud and AI data companies in the market right now. As of March 24th, 2026, Snowflake stock closed at $161.34, down a sharp 7.38% in a single day. That's a big move, and naturally, investors are asking, what just happened? And is this a buying opportunity or a warning sign? Let's break it all down. First, why did the stock drop so much today? One major reason is rising competitive pressure. Recent analyses compared Snowflake unfavorably to Innodata Incorporated, highlighting stronger near-term growth potential for that rival. That kind of comparison can shake investor confidence, especially in a high-growth sector like AI and data infrastructure. At the same time, we're seeing broader macro uncertainty. There's increasing caution across the tech sector due to global trade tensions and tariffs, and investors are rotating into companies with more defensible AI advantages. Another key factor is slowing growth. Even though Snowflake recently reported quarterly revenue of about $1.21 billion, which beat expectations, its forward guidance signaled continued deceleration. For a stock that has historically traded on high growth expectations, that's a red flag. Now, let's zoom out and look at the stock's recent performance. Year-to-date in 2026, Snowflake is down roughly 27%. That's significant. And if you look at the bigger picture, the stock is still about 40% below its 52-week high of around $277 reached in late 2025. Over the past 5 years, Snowflake has been highly volatile, with massive run-ups followed by sharp corrections. So, what exactly does this company do? Snowflake operates a cloud-native data platform that allows businesses to store, process, and analyze massive amounts of data across multiple cloud providers like Amazon Web Services, Microsoft Azure, and Google Cloud Platform. Its key innovation is its architecture, which separates storage from compute. That means customers can scale each independently, making it more efficient and cost-effective compared to traditional systems. More recently, Snowflake has been repositioning itself as an AI data cloud company. It launched products like Snowflake Cortex and Snowflake Intelligence to support generative AI and autonomous agents. This shift is critical because the future of enterprise software is increasingly tied to AI-driven data processing. Another unique aspect is its business model. Snowflake uses a consumption-based pricing model, meaning customers pay based on how much computing power they actually use, rather than a fixed subscription. That creates flexibility, but it also introduces revenue volatility. Now, let's talk about analyst expectations. The one-year median price target for Snowflake is around $284, which implies substantial upside from current levels. Analyst estimates range from about $177 on the low end to as high as $325. Looking further out, some projections suggest the stock could reach around $290 by 2027 and even approach $470 by 2030 if long-term growth trends hold. So clearly, Wall Street still sees significant potential here. What about valuation? After this recent drop, many analysts believe Snowflake is becoming more reasonably priced. Some discounted cash flow models suggest the stock could be undervalued by roughly 30%. Historically, Snowflake traded at extremely high multiples, sometimes over 150 times earnings. Today, that premium has come down as growth expectations normalize and competition increases. Importantly, while the company is still not consistently profitable on a GAAP basis, it does generate strong free cash flow, with margins around 25%. That's a positive sign for long-term sustainability. So, is Snowflake still a buy? The consensus among analysts is still leaning towards strong buy. The bull case is that Snowflake remains a leader in enterprise data and AI infrastructure, and that the current pullback is a long-term buying opportunity. However, the bear case cannot be ignored. Some firms have downgraded the stock, arguing that growth may not reaccelerate as quickly as investors hope, and that competition is intensifying. That brings us to the key risks. First, competition is heating up. Snowflake is facing pressure not just from smaller players like Innodata, but also from major cloud providers like Microsoft and Google, which are rapidly integrating AI capabilities into their own data platforms. Second, revenue volatility. Because Snowflake's model is usage-based, customers can reduce spending during economic slowdowns, making revenue less predictable. Third, margin pressure. Building and scaling AI infrastructure is expensive, and those costs could weigh on profitability in the near term. Finally, execution risk. The company is making a big bet on becoming a central platform for AI agents. If that strategy doesn't play out as expected, growth could disappoint. Before we wrap up, here are a couple of important things investors should keep in mind. Snowflake's remaining performance obligations, or RPO, recently grew 37% year-over-year to about $7.9 billion. That's a strong indicator of future contracted revenue. Also, the leadership under CEO Sridhar Ramaswamy is focused heavily on AI innovation, and the market will be watching closely to see if that vision translates into real growth. At the end of the day, Snowflake sits at the intersection of two massive trends: cloud computing and artificial intelligence. The opportunity is huge, but so are the expectations. If the company executes well, today's dip could look like a buying opportunity in hindsight. But if growth continues to slow or competition intensifies further, the stock could remain under pressure. Thanks for watching. If you found this analysis helpful, make sure to like this video and subscribe to the channel for more deep dives into stocks like Snowflake.